The reality is customers are right more often than they're wrong, but they just don't know how to trade around that. They don't know how to create good strategies because you guys are always trying to hit home runs. So let's talk about the inverse of this. Instead of going out and buying this option, let's talk about selling it. In fact, I'm going to go out here a little bit further out of the money. I want to make this kind of a realistic example. We're going to go out here all the way to the 140s, and I'm going to open up a few more strikes. You'll notice I have 12 strikes open. Let's open up like 16 strikes, make it even more interesting. All right, I know you can't even see all of them now. That'll work great. Okay, so I opened up just 14 strikes. Now we're looking here. I'll supersize it for everybody in the back. So we supersize here, and just look at the 140. It's the 140 calls. Now, just bear with me for a moment. I want you to talk about the 1 calls. Think about them. I'm going to go out and I'm going to sell them naked. Not advocating this. It's just easier to teach the example. So go out, sell the 140 calls naked. What's the most you can possibly make if you sell a 140 call for basically $1.80? Okay? If you sell them for $1.80, the most you can make is what? $1.80. Number one reason that customers don't like to sell premium, that's the most you can make. Limited profit potential. Sometimes huge risk. We'll talk about that in just a moment. We're going to talk about risk reward versus probability here. So if you go out and sell these 140 calls, is that bullish or bearish? Bearish. Selling calls is absolutely bearish. Okay? What's the probability of you making the entire $1.80 in the trade? Oh my God, we got some math whizzes in here. Okay? I did this class in Florida last week, and they even got the answer right. All right? I know it's a holiday. We're a little slow today. Okay? I'm not. I've had a lot of caffeine, apparently. So it's the inverse of the 29%. You basically have a 70% chance of us closing below what? 140. So right off the bat, you know that this trade has roughly a 70% chance of success, correct? But you don't lose money in this trade until we go to 140 plus the $1.80 that you collected. So roughly, what is your break-even point? Okay? Basically, right around 142, we'll call it. Okay, I'm just roughly 142. What's the probability of getting or staying below 142? Almost an 80% chance of success, correct? So the trade has almost an 80% chance of making something. What's the only downside of it? I just went out and sold a call naked, correct? Does that scare you? It should, because most of you don't belong doing that, all right? By the way, people ask me this, can I sell options naked at Thinkorswim? Sure, go ahead, okay? It's your head if you want to get it chopped off. So maybe you should go out and sell them naked on CME. It's a fun stock, you know? Went down $100, went up 70 the next day. It's a good stock for that, all right? At some point, I probably have to do the disclaimer. I in no way advocate the selling of options naked. But if you want to do it, go to town, right? So what we're going to do is we're going to spread this thing off, and then I'm going to give you all the criteria for getting in and getting out of it. We want to spread it off, meaning we're going to sell the 140s, and we're going to turn around and buy another option around it. So what I'm going to do is right-click on the platform. I'm going to drag up to sell, and right down here to vertical spread. And a left-click on vertical spread drops a vertical spread into my order entry screen. So I'll zoom in for a second so you guys can see it. It's a $1 wide vertical spread. I hate doing $1 wide vertical spreads. It makes me crazy. Okay? I'm going to save you guys a lot of money here and just teach you something really neat. Don't do $1 wide verticals on an index product like the spiders. Do a $2 wide vertical. Why? This is a painful one to explain. It's half the number of contracts. It's half the commissions. Okay, is Tom in the room? No, it's half the commissions. All right? Think about this. By the way, don't think if a $2 wide spread is good, a $3 wide spread is better, because it's not. Because there's an actual implied skew that's going to hurt you in here. Some people know what that's about, whatever. Anyway, it's half the think about this, okay, just reasonably for a second. If you sold a $1 wide spread for 30 cents, correct? But if you sold a $2 wide spread for 60 cents, what's the difference? A $2 wide spread for 60 cents, you do one contract. To be equivalent for a $1 wide spread, you'd have to do what? 2 contracts. Just saved you half your commissions in there. There's always a way around, like transaction costs and so forth. You have to learn the business first. So I'm going to do a $2 wide spread here for a 65-cent credit. I like this trade. And I'm going to give you all the criteria behind it. Okay? $2 wide spread for a 65-cent credit. Now, here's the rationale. It's $2 wide spread. So what's the width of the spread? $2, of which you receive 65 cents up front. So what's your definitive out-of-pocket risk? $1.35, okay? So everybody at this point is going to go, oh my God, he's out of his mind, okay? Why would you want $1.35 at risk to only make 65 cents? Because the probability of success is sky high in this trade. When you first get into trading, everybody goes, you need a risk 1 to make 2, risk 1 to make 3. Did you guys know that Risk 1 to make 2, what does that equate in probability? Are you crazy? 50%. If you risked 1 to make 2 with a 50-50 shot, I'd be sitting at home in boxers drooling on myself clicking a button. Okay? Which is not far off my daily thing, you know. And here is the button. But think about that. Every time you were wrong, you'd lose $1. Every time you right, you'd make 2, you'd be a gazillionaire overnight. Nobody gives you a damn thing in this market. You are not going to find, and I'm going to get this out of the way right now, you are not going to find anything that's mispriced. If you find something that's mispriced, trust me on this. Seriously, do not trade it. You're wrong. Call us. We'll tell you why you're wrong. Okay? Email me. If I can't answer the question, I'll actually shoot you over to Tom Preston, who is Rain Man of Thinkorswim. Okay? The servers are having an error or something if something's mispriced because I'm telling you, they're looking at every option and every chain in real time right now with various pricing models. So in this particular thing, we actually at some point will risk 3 to be able to make 1. You'll go out and risk 1 to be able to make 3. If you risk 1 to make 3, the probability of success inherently in that trade is 25%. No if, and, or but about that. If you risk 1 to make 3, you have a 25% chance of success. After commissions, it's like, call it a 23% chance of success. Because there's always some character in the crowd who goes, what about commissions? I don't know, what about it? Okay? So now you have a 23% chance of success if you risk 1 to make 3, correct? How's your trade sound? By the way, if you risk 1 to make 3, I'm going to bet you anything that you bought that position, didn't you? You bought an option of some kind. Anytime you buy an option, it starts to do what? Decay. Every day it decays your probabilities. So all the time you're burning time. You're like, oh, expiration, stay away, expiration, stay away. When most professionals are like, expiration, come on. Okay, get on with it already. All right, and by the way, January was a rough expiration. I've never prayed so hard for expiration. You know, it was like January. And like February, in February, the spiders were down a lot. And I'm like, holy crap, hold off just a day or two. Let's rally another day and we'll be okay. By the way, they're rallying. They're going to rally tomorrow because it's after expiration. And I am sure that, yes, there is that theory that, you know, it's the maximum pain theory. The market will go to the point that will screw the most people at one time. Okay? In fact, the reality of the entire marketplace is the market as a whole goes as far out of its way as possible to screw each and every one of you individually. Once you understand that, you're going to be better off. All right? I swear that's true. Okay? So in this trade, we're not going to go out and risk 1 to make 3. We're actually going to risk $1.35 to make 65 cents. What's the probability of success? There's a cheating man way of doing this. Take the definitive risk in the trade. The definitive risk is $1.35. Take $1.35, divide it by the width of the spread. What's $1.35 divided by $2? Okay? You're right around, let's just ballpark it. Okay? You're right around, what, 67.5%? Is that ballparked or is that accurate? I don't know. All right. It's about 67.5% probability of success. So this trade has a 67.5% chance of success. Do you like it? Yeah. Fire at will. You go, how do you know it's a good trade? It fit within my probabilities. What are the rough probabilities you should always have in a spread? I like to keep mine between about 60 to 70%. Everything I do.